Good morning. It's Monday, the 9th of September, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital. The take. There are two kinds of people in the stock market, particularly the primary markets, about which or whom we will speak of today, the givers and takers. Givers are those who invest their savings or earnings in initial public offers in anticipation of future returns, including on listing day, as we're increasingly seeing. And takers are those who raise funds from the market, either for themselves or their companies. Now, there come times when the taker's appetite exceeds that of the givers. Now, usually this happens at the top of cycles and leads to the whole market, primary and secondary, going down or at least cooling off. So the question is it happening now? The honest answer is one does not know whether we are at the top of a cycle. But what we do know and can see is that substantial wealth is being transferred from ordinary investors into the hands of promoters of companies or their companies, oftentimes the former. A recent report by brokerage Kotak Institutional Equities said that promoters of 37 NSE 500 companies sold about 87,000 crores worth of stock in the first half of the current year, marking the highest level in the last 5 years. In 2019, the value of promoter stake sales were about 24,000 crore rupees, and they touched about 99,000 crore rupees for last year, according to a report in the Mint. Another report in Nikkei Asia said promoters sold shares worth about 81,000 crores between 2021 and 23, and of the 183 stocks that were part of this sample, 44 were quoting below their offer price or below water. Now, there is no easy formula that says at what point the takers take so much that the overall market starts feeling the pinch. One reason is because domestic flows are strong and are absorbing both IPOs and, of course, sending fresh funds into mutual funds or, for that matter, even secondary markets. But there is definitely good reason and history to believe that overheated IPO markets usually trigger a flattening, if not drop, in secondary markets too. So the question once again is, are we at that point? A few weeks ago, we heard of a motorcycle showroom in Delhi raising funds through an SME IPO, which of course was oversubscribed substantially. Now, these SME IPOs are only regulated by the stock exchanges and not by the Securities and Exchange Board of India. Now, there are several other such IPOs documented where the antecedents of those companies were shaky, to say the least. But in my experience, it's signs like these that are more worrying than the data that may or may not provide clear signals, particularly, once again, when the flows are so strong. This week, meanwhile, 4 companies, including Bajaj Housing Finance, are likely to raise about 8,400 crore rupees. The month of August, that's last month, also saw several major IPOs, including some from some tech companies. Now, estimates suggest that main board IPOs, as they're called, as opposed to SME IPOs, have raised about 80,000 crores till last month and could cross 1,25,000 or 125,000 crore rupees by the end of this calendar year. And appetite is clearly high, going by the extent of oversubscription. In August, these main board IPOs were subscribed to on an average over 75 times, while the year-to-date average for 24 is about 66 times. For SME IPOs, the average subscription in August was 290 times, and the year-to-date average was more than 259 times, said a report from PTI quoting data. Now, such high levels of appetite are warning signs in themselves and reflect a desperation to make quick returns rather than anything else. This also means that such capital can be fickle rather than patient. We are most likely today in a steady phase of market growth rather than one of hypergrowth. Now, this is, of course, good for the overall health of the stock markets, and unless something major happens, it could well stay in this mode for some time, if not a longer time. But as long as the takers don't get greedy and kill the golden goose, so to speak. And that brings us to the top themes and stories for the day. Why markets are still holding weak. Demand woes push oil prices lower, now at about $71 a barrel. Basmati rice exporters project a bumper crop, want export curbs to be removed. The United States government warns against doing business in Hong Kong. And the summer of 2024 has been the hottest on record.
This is the Core Report with Govindraj Ethiraj.
The stock markets are inching down. The stock markets are on a weak footing right now, not so much because there are negative news flows, but there are no major positive cues either, at least the kind that can or could send the indices racing up. Not surprisingly, local markets last week responded to global negative cues, and macro factors like interest rates in the United States, which are expected to fall this month, are important factors that affect world markets. But it's somewhat amusing to see institutional investors in India or other brokerages talk about US jobs data, given that actually there's no direct correlation between the Indian and the US market. But of course, US job data does affect sentiment on Wall Street, which affects markets world over, and then, therefore, Indian markets. There's no denying that. On Friday last week, the stock markets dropped sharply with the Sensex losing about 1,017 points to close at 81,183 and the Nifty closed 293 points down to 24,852. A Reuters report said that the Securities and Exchange Board of India could expectedly, that is, tighten derivatives rules to raise both entry barriers as well as increase trading costs, obviously to rein in speculation. And last week was a tough one for Wall Street too, with the major indices showing losses and tech stocks taking a beating, thanks particularly to questions being raised about artificial intelligence's ability to deliver real business outcomes, something that we've been referring to here. The Nasdaq Composite Index was down 6% for the week. Apparently, it's worst since January 2022. The S&P 500 was down 4%. The Dow Jones was down 3%. Forex reserves hit a high. India's foreign exchange reserves have risen for a third straight week to a record high of $684 billion as of August 30th, according to Reserve Bank data released on Friday. The reserves rose by about 2.3 billion last week after having risen by about 11 billion in the previous 2 weeks, according to Reuters. The rupee, however, continues to stay weak, presently at about 83 rupees 94 paise. One, of course, hopes that these rising reserves prompt the regulators here, that's the Reserve Bank, or for that matter, even the government, to liberalize outward remittances further. Oil prices stay down. The Organization of Petroleum Exporting Countries Plus has postponed a possible oil supply hike by 2 months. Now, this is in response to falling prices, and an attempt to keep them higher by managing supply or constraining them has not worked. The move wasn't enough to roll back steep losses in crude prices amidst fears of fragile demand, Bloomberg reported, adding that the key coalition members at OPEC won't now increase production by 180,000 barrels a day in October and November, according to an OPEC statement. Oil, however, showed little reaction to that news, with prices remaining around $73 a barrel in London over the weekend and then slipped further overnight to a little over $71 a barrel. A Julius Baer analyst told Bloomberg that a delay does not change many factors in the market that are unfavorable to OPEC. Demand is partially stagnant, and the oil market will likely head into surplus supplies next year. Rice exporters warn of a bumper crop and want export caps removed. India's Basmati rice exporters want the government to scrap a minimum export price of $950 a ton. Exporters can only sell at this or above this price right now, but not below. The high export price cap has affected their ability to compete globally and is also causing a buildup of inventory as there is a bumper rice crop anticipated, according to them. Now, exporters are saying that either the minimum price should be scrapped or it should be brought down to $750. The South China Morning Post quoted the All India Rice Exporters Association saying, India is the world's largest rice exporter and had banned exports of non-basmati rice last year in an attempt to control prices in the domestic market. Some 40% of global rice shipments originate in India. So the other problem is Pakistan, whose rice is similar to that produced by India and are being exported at apparently $700 a ton. The Rice Exporters Association official told the South China Morning Post that India could produce about 9 million tons this year of basmati rice compared with about 8 to 8.5 million tons last year. So the interesting bit is that the rice crop is strong despite heat waves and extended and heavy monsoons, or rather have worked in the crop's favor, which is usually harvested between September, that's this month, and October. Rice is a water-guzzling crop and does usually better when there is abundance of water. I reached out to Vijay Setia, former president of the All India Rice Exporters Association, and I began by asking him why the industry was asking for a scrapping of the export caps.
You see, government concern for the Indian masses was real, and they wanted there should not be any inflation in the rice, which is a common man's diet. So they were very right, and due to some, you can say, procurement policy and some policy reasons were there, which was causing a difficulty for the government despite giving free rice to 80 crore people. Still, in the market, prices were on the higher side. So they have to control that situation, and they very wisely made certain taken steps to control the Indian prices, where they have succeeded very successfully. They have controlled the inflation in Indian market. So that part is now over. That problem is over. Now we are facing a different problem, that our warehouses are full. Our rice millers are still holding last year's material which they have to supply to the government. There is no space left with the government warehouses in many states. So when you are facing a problem of too much rice, plenty of rice, then you have to revisit your whole policy. You have to improve your policy so that you can give better price to your farmers. You can give your industry to work freely, and some more value addition can be done to the raw material and paddy. This is, I think, now time has come. Government has to review its old policy, which is not required at this moment. If we continue with that policy, that will cause more damage than any benefit to the country.
Right. So, could you give us a sense on how it breaks up? For example, the government's floor is $950, but that's on premium basmati rice. And you're saying there's an oversupply in the domestic market. Is it the same types of rice that are overlapping, or how does it work?
You see, India produces large number of good quality of rice, and basmati is given a special status, and it was always in OGL, open journal license like situation. Without any government interference, it was allowed to export. Last year, first time government came with this proposal that because of in the name of basmati, people may not export non-basmati. So they brought this 950 into operation. At that time, trade accepted it. Government first thought of a average export price of 1200 USD, which trade pleaded there are a number of basmati varieties which cannot be exported. Finally, after committing 850 by the Commerce Minister of India, after a 1 month again they said no, not 850, it should be 950. So trade accepted it and worked accordingly. But now when you have a competitor in Pakistan, they are using your seeds like 1509, 1121 and other varieties. They have stolen from India. They have taken away seeds from India. We could not protect them. Now they are growing those seeds and competing with Indian exporters in international market. They have very cleverly done one thing, that when they saw Indian government has fixed MEP of 950, they made the lower level at 700. So that means all varieties of 1509 Pusa, which are at the lower end because of they have a inherent problem, less head grain recovery, more brokers. That's why their paddy sells at a lower price, but it is a farmer friendly, high yielding, short duration. So now Pakistan, if sending that material in the international market at 700, so Indian exporters cannot give better price to farmers in India for these varieties. It is only possible if aggressive exports are allowed. And it is only possible if we remove 950, which has become a barrier. Indian exporters cannot export varieties like 1509 and Pusa 1 at the price range of 950. So when our crop size, which consists of 60% of these two varieties, that means large number of farmers are going to be affected if we did not change this policy. If we remove 950, the cap, the purchaser will become aggressive in the market. They have a clear scenario before them that we can export this material. Right now, they don't have that clarity. So if they cannot export at 950, then they think the Indian market cannot absorb this much material. It is premium variety, but it will be selling like a lower price and they don't want to lose money.
I'll come back to the domestic market, but could you give us a sense on how the market is looking from the import side, as in from the demand side internationally this year?
You see, Indian basmati exports are growing, and which we can see for last 15 years. Every year we are improving. If the prices we look for the last year, average export price was good, despite lot of difficulties from logistics sector because of war and shipping lines raising their freights too much. Still, we are able to export higher quantity and the realization is better. That means industry is doing their job correctly. So government interference does not helping to improve anything. That is now becoming a hindrance. So I think export demand will remain good, but they will definitely see where is the more profit, then they will go to Pakistan, not to India. Delay will cause loss to Indian farmers and Indian industry, that is for sure.
If I were to come back to price and production of it in India, so we've had a very strong monsoon, maybe more strong than what was expected. What's the impact on that going to be in terms of production overall as you go ahead and look towards the end of the year?
Yeah. You see, till date, there is no insect pest attack on any rice variety. I have not heard in the northern India. So that means we are heading towards a excellent crop. Rice is basically a grass, and intermediate rains are very helpful to it. Only thing, if the monsoon continues for some more days, it can delay in harvesting. I think no other loss is coming to the rice. Maybe some people are to create the market scenario say that too much rain will cause loss. I don't see. Only where we have seen floods, too much rain and floods, only in that part we loses crop, but rest of the crop is always benefited. So I think this year we are going to have a bumper crop, and the climatic conditions are very suitable. Night temperature is good. It is not that warm. So that is an indicator we are going to get a very good head grain recovery of the rice also. It won't be too much broken this time as compared to last year. So I think availability for export rice will be too much. The government of India, like wheat, they buy rice which is meant for common man, for PDS. That is 100% procured by the government. No policy, no economics says that one government should buy 100% any product. If I talk about wheat first, let me give 1 minute on that. First, you buy wheat, and then after 1 year or 2 years, you are giving it to the rice miller, flour millers. How much quality deterioration? Nobody is measuring that. You see, if someone is stealing the wheat and putting water on it, all insects, all fungus, aflatoxin will be coming, which will become cancerous. And that wheat flour, that means there is no proper checking. So government buying 100% and then giving to the flour mills does not suit. It should be government should buy 40%, 50% for food security. Rest should be handled by the private trade. And if there is inflation, then government can offload their material or some imports can be allowed so that they can cool the market. And wheat definitely going to be a concern in the coming future because of weather changing and our wheat crop is not going that much up. So coming back to rice, the non-basmati rice, which is a common man's food, again, state governments had made a policy that rice millers will be buying on their behalf at MSP, but nobody is buying at MSP. Reason being, कि farmers are bringing their material with a very high moisture, unclean material, okay? So what commission agents are doing, they take the MSP as a benchmark. You have a more moisture, so you will get 2 rupees less. So farmers are not bringing the right specifications of material in the mandi and they are getting lesser prices. Then the whole material is going to the rice millers for custom milling when the common man's rice is with the government and how you can manage the inflation. So this is where government starts Bharat rice, sometime free distribution. So that does not work. If you look at 20-25 years back, our policy was the government will buy only the material in those areas where rice millers are not buying to support the farmers. They used to buy at MSP. So, of the total material paddy, 10-15% was for CMR. Now, 100% paddy is going for CMR, has created a vicious circle. The rice is circulating into the system. It is going to the government warehouses, coming out again, reconditioned and going to the government like that. So, government has got a lot of millers But why you make a policy which gives this type of loopholes and leverages? Lastly, I will say the current policies are helping only those who have aggregators outside India or their offices outside India. They are averaging and exporting, whether it is non-Basmati or Basmati. And 20% duty is 100% wrong conceived idea. It should have been like $100 or $50, anything government feels fit. So nobody can do under invoicing or over invoicing. That's all. So my submission is that government needs to see it carefully, because in 2009-10, the government in Thailand just failed and their prime minister has to resign because farmers' expectation went up like anything because of too much inflation in 8-9, and they procured entire of rice, paddy, everything. They don't have that warehousing and quality deteriorated. Some cheating and some wrong things happened and it became a scam. And ultimately, Prime Minister has to resign for rice. This is the record. So our bureaucrats, they are not realizing what problems are associated with the rice and wheat. If you buy too much, the cost goes up for storage and everything, and quality goes down. So, this is my message.
Right, Vijayji. Thank you so much for joining me.
Thank you.
US warns against doing business in Hong Kong. Hong Kong's reputation as an Asian financial power center took a fresh blow after the US government warned of heightened risks for firms doing business in Hong Kong, including the possibility of running afoul of expanding US sanctions, a move that comes amidst a continued corporate exodus from the city, according to the Wall Street Journal. So doing business in Hong Kong, which is legally distinct from mainland China, but increasingly, as the Wall Street Journal says, in Beijing's orbit, poses a number of reputational, financial, regulatory, and other risks, according to the US government, which said so in a notice on Friday last week. And that notice was interestingly issued by the US Departments of State, Treasury, Commerce, Agriculture, and Homeland Security. It's the hottest summer. The summer of 2024 was the hottest on record, according to the European Union's climate monitor. The EU's Copernicus Climate Change Service said on Friday the global average temperature for the boreal summer, which refers to the Northern Hemisphere's June through August period, was the highest on record. The summer months were found to be about 0.69 degrees Celsius above the 1991 to 2020 average for the June to August period. It also surpassed the previous record from June to August last year, which was 0.66 degrees Celsius above the average baseline, according to CNBC. The C3S said that the string of record temperatures is increasing the likelihood of 2024 being the hottest year on record. Now, high temperatures affect food prices and production in India, apart from impacting productivity, as we saw in the last few months. The auto industry, for example, blamed high temperatures for customers not turning up at dealerships and thus slower sales in the summer months in India. Now, there are many more areas of the economy that are impacted by high temperatures, but perhaps not as well documented or studied as they should be. On the other hand, sales of air conditioners, among other cooling devices, have done well. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.